Hello and thank you for watching. This is Rene with Nationwide Purchase Loans. Today's presentation is going to be on the several agencies that guarantee home loans in our country. Talking about Fannie Mae, Freddie Mac, FHA, VA, and USDA. Now this is relevant because these agencies have a lot of power. They quite literally control the vast majority of residential financing here in the United States. And the way it works is that each of them publishes their own guidelines for their respective products. And lenders will originate loans that meet those guidelines. And as long as those loans close, meeting all the requirements, then they're eligible to be sold in the secondary market. And that's really important for lenders because that's how they get their money back so that they can keep doing business. Otherwise, they would have to go out of business as soon as they run out of money. Now, because I am pragmatic and I don't want to just bore you with information on these agencies, I'm also going to include information that helps you identify when it's a good idea to go to Fannie Mae versus Freddie Mac, FHA, VA, and some cool things that each of them does that the others don't necessarily do as well. So let's get started with the first two, Fannie Mae and Freddie Mac. They do conventional loans. And while they are actually privately owned, they are government sponsored, whatever that means. FHA and VA are both part of HUD, and USDA, of course, is its own agency and a part of the government. There's more too, but I'm only going to cover the major agencies that we've already listed above. Now, back to the issue of guaranteeing. What exactly does that mean? Is it a guarantee that the person qualified for the loan? Is it a guarantee that they're never going to miss a mortgage payment? No, it's a guarantee to the lender that if that loan goes into foreclosure, if the lender collects the equity after selling the house and after they add up all the expenses from having to foreclose, including attorney's fees, court fees, the balance on the loan, the late fees, all the interest, if there's not enough money there to cover all of those losses, then the guarantee from the agency makes the lender whole. And that's pretty important. It makes the world go round, at least the mortgage world. So let's talk about each of these agencies and something cool or a couple of things that they do that the others necessarily don't. Let's start with Fannie Mae. Fannie Mae allows border income, specifically on their Home Ready product. That means that if you have a roommate and they are paying you $500 or $600 a month for a bedroom, you're able to use that to qualify for a refinance. Or if you're buying a home and you have a roommate that's paying you and you can document a history of it, you can use it for a purchase as well. Now, Fannie Mae does not consider a mortgage that is included in a bankruptcy as a foreclosure, whereas Freddie Mac does. In other words, if you file bankruptcy and you include your mortgage in the bankruptcy, Fannie Mae will give you a loan after a 2-year waiting period, whereas Freddie Mac, they're going to treat that as a foreclosure. It's going to be at least 4 years before they will touch your file. Fannie Mae has simpler trust income requirements, and one of my favorites, they deduct alimony from your qualifying income instead of actually hitting your DTI. And I did a quick calculation where I kind of made up a scenario. This guy makes $10,000 a month. He is applying for a $3,000 mortgage, and he's got $2,000 in alimony. If we add the $2,000 to the $3,000 and then hit the DTI, we are going to be at 50%. If you take the $2,000 in alimony and you subtract it from the income, and then you just divide the $3,000 by the remaining income, you end up with a lower DTI. I think it was about 12.5% lower. Point being, you'll qualify for more on a Fannie Mae loan if you have alimony and you calculate the income that way. Freddie Mac allows ADU rents. They also allow you to go higher in loan-to-value ratio when you're buying a multi-unit owner-occupied property. They also will not automatically require you to pay off collections. I'm thinking investment properties. Fannie Mae has hard limits. Like if you have collections that are more than $5,000, you have to pay them off. Whereas Freddie Mac, their automated underwriting software is going to read the entire scenario and tell us whether or not collections have to be paid off. Also, and this is my favorite for Freddie Mac, they have a very low calculation for student loans. When we pull credit and we see that you have your student loans deferred and that the monthly payment is 0, we're obligated to calculate a payment. Fannie Mae uses 1%. Freddie Mac uses 0.5%, and that means qualifying for more. FHA is great when you have a lower FICO. They'll go all the way down to 500. They also allow a higher debt to income ratio. That means you can qualify for more with them versus a conventional loan. Conventional loan will only go to about 50, whereas FHA can go to about 56. And they have fixed mortgage insurance rates. If you have a 620 FICO, you are going to get a higher mortgage insurance rate on a conventional loan than someone who has a 700 FICO. But with an FHA loan, everyone pays the same exact amount. The actual MI is determined based on your loan amount and the amount of your down payment. And FHA has low and zero down payment options available. That means that if you are trying to buy a home but you don't have a bunch of money, FHA is probably your best bet. VA. No debt to income ratio limit. It's all AUS driven. That's the automated underwriting software. There's also no loan limit, but I can tell you most lenders set their own limits. Again, we're talking about agency requirements here, but a lot of lenders will set their own loan limits. I think for the most part, the highest loan I've seen for VA is going to be about $2 million. VA has no PMI, whether you put a down payment or not, and they have a very streamlined refinance process. All right, here's USDA, and this is the last one I'm going to go over. USDA likes to do business in areas that Fannie Mae and Freddie Mac and FHA don't really like to go into. Now, I'm talking about financing for a single family residence here, not a farm. And what's important is that they will do loans that no one else will. Like if you have a property that has 10 acres, Fannie Mae and Freddie Mac, they don't really want to do that. But USDA would, as long as that property is typical for the area. As long as all the other neighbors have acreage, then that should be allowed. They also allow FICO scores down to 600, and they do not require a down payment if you meet their income limit. And last, they also don't require PMI, whether you do 0 down or 5% down or 50% down. A couple things to remember. There's more agencies. The one that I left out that I'm thinking of is Fannie Mae. But again, I wanted to cover the major ones and the ones that I actually know well. Then there's private money. There's private investors out there that do business as well. And their guidelines are all over the place and they change frequently. That's why I think I have a job. Please remember that we are here to help. If you're trying to navigate whether you should be looking at an FHA loan or a Fannie Mae loan or a Freddie Mac loan, please know that we're here to answer your questions. Thank you for watching. Thank you for your time, and I hope you have a great day.